Hello, today is Saturday. It is the 9th, first week of trading in the new year. While it was absolutely insane, it was very, very strong. We'll talk about that. What I want to get into first, as you can see, it was a fantastic week. What looked like was going to be a breakdown was simply, obviously in hindsight, it's easy to say this, but it doesn't surprise me, to be honest with you, which is why I didn't make any moves. There was some early profit taking on Monday. So we had actually a gap up again. The market was higher on Monday and sold off hard. Just a lot of profit taking into 2021, a lot of high flyers. Those names really, really struggled. Monday was not a fun day, but we quickly rebounded. And as you can see, value, the Russell 2000 continues to outpace, but it doesn't mean that the other areas are not going to do okay. So we'll get further into that. What I want to kind of show you is general themes, because what I'm seeing is the hardest thing right now is to ignore the news as it relates to your investments. If you can separate those two things, the better investor you will be. What I'm seeing a lot of is some clients reaching out. And again, none of this is a recommendation. I know a lot of people watch these videos, but none of this is a recommendation. None of this is advice. This is just a general opinion. We're trying to figure out the market. It's not easy to do. Just general themes. So I want to show you some things that a lot of people are asking questions about. Okay. So again, if you want to see like what I'm thinking each week, I either do a write-up. So you can go to gurneyfinancial.com, go to blog. You can see the write-ups or the video. So I haven't done a video in a while, but the last week was a write-up. And you can see here, there's some general themes here that are very important. Again, the market tends to rhyme. It may not repeat itself, but it does tend to rhyme. And look how similar this is. This was as of last week, so the close of 2020. Look how similar this is. Again, 2021 is the orange. 2009, 2010 is after the last recession. It's a little scary how similar these moves are. So we're getting into this range where you rally early. Do we see a 5% dip? I don't know. Would it surprise me? Not really, but that does not mean it's not a bull market. I mean, these are 5%, 10%, 12%. They happen every year. Now, I'm going to try to prevent that. And what I'm doing is basically every day we go higher, I take another 3 to 5% off. Okay. So collectively, again, across the entire fund that I manage for different clients individually, some are low, medium, high risk. And collectively across all of them, we have about 73%. So low risk has about 50%. Medium has about 75 and 80-ish% for higher risk. So I'm definitely taking gains into this. I will not perfectly time a top nor a bottom, but at this point, I don't think risk reward is great. Does not mean I don't want to participate. So again, I'm not bearish on the market. If you ask me what I think it's going to be at the end of the year, I think we're much higher, but does not mean we're not going to have some things to work through. So in short, the market is not the economy. We talked about this several times. We've talked about this in March to say the market will recover faster than the economy. How is it you can see this? A lot of people just cannot separate it. They think it's crazy and they take their money out, which is what I try to talk people down from. But here we go. This was as of Friday, okay? The U.S. economy lost 140,000 jobs in December, though estimates were basically a 50,000 gain. You're like, that's horrible news. You're absolutely right. But listen, the market, that is the way it works. Historically, this is the way it works. The market performs the best when unemployment, job numbers, the economy is not great. Why? Because the Fed steps in. Usually the market is lower. It's not right now, but we've had a massive rally. Look, when unemployment is above 9%, the returns versus when things are good and everybody is considering, hey, things are great. Why wouldn't I invest? The returns are the lowest number. So again, it's counterintuitive. When things are worse, the annualized returns are usually higher. This is a common thing. No different than buy the dip. Buy the good names on dips. Usually everything goes down. It doesn't matter whether it's bond, gold, silver. Usually everything goes down on dips. Despite what people may think, gold and silver got hammered as well. Now they have definitely rallied as we started to recover. So the economy still is not great. We have a lot of things to work through, and this number could be ugly for a while. So maybe it's between one of these ranges. I don't know. I don't have a crystal ball, but the point is, don't bring your politics into this. Do not assume just because the economy is bad that the market can't do well. These are reoccurring themes. So I hope that helps. But as you can see, it was a great week. Can't complain about that. What we are noticing is a lot of rotation. So I want to show you the 1 day, which is interesting because as you can see, the Russell 2000, the IWM, is really what has been outperforming. And you can see these rotations between growth, or the tech companies, and value, a lot of smaller companies which have really struggled but are recovering, is these are rotating back and forth. And as you can see, like recently, the NASDAQ, as you can see here, I mean, this was as of, we had an ugly little dip here and it recovered so fast, but we're seeing movements, we're seeing rotations between growth and value. So I think you got to have some in both and not just be, if you think, I do not think this is just going to be a year where you can say all growth and momentum is just going to be a killer year. It'll do fine, I think, but you're going to have periods where it's rough. And at the beginning of this week was living proof of that. I'll be honest with you, on Thursday, had momentum growth not recovered, I was going to reduce even significantly. And that's just, it wasn't an emotional decision. It was, hey, this is falling apart. I better get out. But it recovered when it needed to. And that's what I'm seeing. A lot of individual names, a lot of indexes are recovering right where it needs to. Look at how this trend is above the 20-day moving average. Again, are we overbought? Yes. But what's interesting is the 10-year leader of all the indexes, which is the QQQ, is the least overbought at this point. Kind of interesting. So we are seeing a rotation. Could we see a little bit more? Yes, even after the bell Friday, this number is a lot higher than this. I can tell you that. I was watching the price action after, and this moved much higher even after the bell. So it's very, very interesting. But let's look at the benchmark, the S&P 500, which we try to beat every year. Some years we do, some years we don't. Most years we do. But you can see it's above 70. Doesn't mean it's going to, fall off a ridge here, but it can go higher. So I want to participate. And again, right now, collectively across all assets, we have about 73%. That's where I want to be. If we gap up Monday, I'm going to sell some more. It's not because I don't think things are going to go well, but when I see indexes this high, like the IWM, it's just not great risk reward. I want to participate because the backdrop is good, but I also don't want to get killed. So this is great price action. We've seen where it can stay above 70, but it's just not great risk reward here, and that's just being a realist. Again, if you were to hold all of this to the end of the year, probably 10% higher. But I'm going to try to prevent the dips and add during the dips. That's just the way I manage assets. As you can see, it does look kind of similar to these times where it could go sideways for a little bit, chill out the RSI. Maybe it's one here where we need more time. Maybe we need a full month of sideways. Not bad price action. Does it go higher? I don't know. I don't have a crystal ball, but I can tell you January to February tend to be weak months. Toward the end of mid-January to end of January tend to be weak months. Doesn't mean it's going to happen, but interestingly enough, that's exactly what happened here. Again, doesn't mean it happens, but wouldn't surprise me, to be honest with you. So that's kind of where I stand, is every day we go higher, I'm going to trim a little bit more so I have cash in case we go lower. It's just good risk management, okay? So let's go into some of the other charts that we have for you. Let me see here. Okay, this is just breadth indicators. You can see in the S&P 500 that the 8-day is still above the 21-day moving average. Very consistent. We had a little bit of a scare here, but nothing to significantly move on, in my opinion. Every dip is being bought right now. It doesn't mean you add crazy amounts of money here, but on dips, everything's getting bought. Until that doesn't happen, it's hard not to. The put-call ratio, basically a complacency measure. We're pretty complacent. Where the yellow area is kind of below 45. Below 40 is really kind of like, hey, should I have a ton invested here? Probably not. But it is at 44. Does not mean the market's not going higher, but it is definitely, this has been here for a long time. This just truthfully should show you how strong the market is. Doesn't mean you sell everything, but it is interesting and so it definitely noteworthy. I mean, we have to be real about that. Risk reward is not great. We'll go over maybe some Bitcoin and Tesla to kind of show like, hey, congratulations to those who stuck with it. We've been trimming on the way up. We still own a little bit of it, but we got to be careful here in some of those names. The QQQ, this just shows you, listen, when we get consolidation, these are the worst times, but they usually lead to good things. So a 10% dip, about a 10% gain, boom, down again. And once we get out of that and break out, this was not a fun period. It's not fun at all. This was going into the election. The market basically viewed this as another thing to work through. And once it did, it really didn't matter who won the election. It was just that we got through it. And just so you're aware, you're not going to like this, but well, some won't like this, but whether you're Republican or Democrat, it doesn't matter. When even the Senate controls is Democrat led, the market tends to do extremely well. So don't make assumptions just because everything is blue right now that the market's going to tank. That's definitely not my assumption. That's just for those that are far right. It's important to understand that the world is not ending. The Democrats too had to deal with the strong red for the past few years. So get past that. We got to get past politics. Don't let it impact your investment decisions. Let's move to the 10-year Treasury. As you can see, and we talked about this, usually going into an election, rates increase, whether you like it or not. The 10-year yield does increase, which is usually not a bad thing for banks. That is the case. The trend is higher. I'm surprised to move this high this fast. Amazingly, it is overbought. Or just, I shouldn't say it's overbought because it's a Treasury yield, but it had a nice move. Let's just put it that way. The change, we talked about that. Percentage of stocks above the 200-day moving average. Just kind of interesting to kind of see perspective. We are pretty hot. 90, we've seen 96 in 2009. It just kind of shows the correlation to 2009. Doesn't mean we don't go higher, but it's pretty hot. I'm not going to say it's cooked yet, but it's pretty close. Christian Frommerich, you should like that one. That's a steal from your language. Not saying you agree with that commentary, but that's definitely a steal of the cooked line. This is showing active asset managers, basically their exposure. We showed, hey, that some people are going into margin here. That 105% of their portfolio invested, basically going into margin. It's still very elevated. Doesn't mean the market doesn't go higher, but it's something to be mindful of. Here's another one. There was a little bit of a scare in this because this was trickling down. We were seeing a divergence between the indexes where the indexes were going up, but the New York Stock Exchange McClellan Index was going down, which is not a good thing. But this could easily trickle back up, and it looks like it may do that. So something to watch, not something to immediately sell on, just something to keep an eye on. we talked about this too. This was a while ago in October where we said, hey, we're seeing a breakout in the correlation between IWM and SPY. I think it's done pretty well once it broke out, don't you? Now, do I think it's a great time to add to IWM or the Russell 2000? No, but doesn't mean it won't be higher by the end of the year. And it would not surprise me that it may outpace some of the growth momentum areas. So in short, what I'm saying is I don't think this is going to be a year where you can just say, buy the crowd strikes, buy. And yes, I do think a crowd strike's going to do completely fine, but I don't think it's a year where you can just buy growth momentum and it's going to be as strong of a year as last year. I think you're going to have to get into some oddball names that actually require some research. So I hope this is helpful. Again, don't bring your politics into it. Don't assume because the economy is not good that the market should also be bad. That should be the lesson of 2021 or 2020. And we're kind of in that same boat now. So a lot of people do believe that, you know, we've been in consolidation for basically 2 years in the S&P 500. We just broke out and this could lead to another many years of bull market. I'm kind of in that boat, to be honest with you, but you're going to see the traditional 10 to 12% dips every year. On average, you see 3-5% dips. It's going to happen. So if you can work through that emotionally and mentally, it's probably going to be a good year for you. If you can't, again, we try to prevent those dips. But the reality is, think of the bigger picture. I think it's going to be a really good year. I'm not just saying that. If I didn't think it was going to be a good year, I would be in cash. And I'm being realistic by saying I don't want to be adding here. I want to be reducing into strength. So it's been a great start to the year, but I also don't want to give up gains. So I want to participate, but not get killed. And that's kind of where we, as you can see through the charts that I was showing you, that's kind of where we stand is the Russell 2000 is the most overbought of the indexes, with the QQQ or the NASDAQ essentially being the least overbought, which is interesting. I don't think the Qs are just going to roll over because value is going to take over the world. I think people are assuming that, but I think there's way too many people that will buy the Qs on decent sized dips, and that's definitely what's happening. Any dip is being bought right now. It's hard to ignore that. If you're bearish right now, I wouldn't be bearish because price action has not suggested it. Once price action suggests that and the 20-day does not hold, you can change your perspective. But for right now, not seeing it. That doesn't mean you don't reduce exposure. So hope that helps. Again, none of this is a recommendation. This is kind of just being a realist to say, listen, there are opportunities. Oh, and I promised a Tesla chart. Again, this is out of the cloud. Doesn't mean it can't go higher. It's a religion stock. It's going to go at multiples. I mean, that's the strongest I've maybe ever seen in the scooter rating, 99.7. It is now an RSI of 83. It can go a little bit higher. I don't expect much higher. 85 to 90 is a sell every time for me, but trim into it. Like if you're looking, a lot of people say I have Tesla in my account. Do I sell it here? And I say, are you going to be mad if you sell it and you don't time the top? If that's the case, trim it. You know what I mean? Slowly get out of it. I can tell you I'm not adding into Tesla right now. I'm riding it a little bit longer, but I have very little left in it. I think it's crazy. But it's a religion stock, just like Bitcoin. We've talked about this in many of the commentaries that I have. It doesn't have to make sense. There's a religion in it. People believe in it, and any dip that there is in it is being bought. It's momentum. You want to be involved in it while it's great. You don't want to be involved in it when it's bad. I mean, general themes, we talked about this. When things consolidate sideways for a long time or in a range for a long period of time, when it breaks out, it's a strong breakout. I mean, it really consolidated again here for a month and did it again. So I truthfully am surprised. Like I thought it was going to get added to the S&P 500. So I was wrong on that, but it doesn't mean I sell the position. I leg out of it. You know what I mean? So I was wrong in saying I thought I would never trade the same, but it doesn't mean it's not going to see dips. It's just a ton of momentum. So appreciate your trust. Let me know if you have questions. Thanks, guys. Bye.